Welcome back. You're watching Stock Watch. Joining me to unpack your stock-related questions this afternoon is Chantal Marx from FNB Wealth and Investments. Start sending your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Chantal, a pleasure. Good afternoon.
Hi, yeah, it's great to be with you. It's a new face for Stockwatch, but we've spoken a lot of times on Stock Picks.
Absolutely. So I do hope that you and I can keep it going, Chantal. Quite a few questions actually from viewers this week. I think we'll go straight into it. The first question is from Rob Gooseman. He says, what is your opinion of Rhodes Food Group at present with capital growth and increased dividends in the future?
Rhodes Food Group has a broad category set that exceeds the branded goods that you'll find in your supermarkets. And their most recent expansion is into the pies category. And it's just a really good example of how good Rhodes is, or RFG is, at integrating little acquisitions into the broader business. It's a really smart business model because you don't end up spending a lot of cash in order to make a big transformative acquisition. You just kind of continue to grow organically and then add on these little mergers and acquisitions. They also have a big international business, and by international, it's mostly export orientated. So the good thing for them is that they are also able to benefit from external demand for some of their products, which I think will offer them good growth into the future outside of just what is available in South Africa and the regional business, which will also include our African neighbors. So I really like the company. I think their market positioning is really good. They're either first or second in terms of market share in most of their branded goods as well. And I think that there's still so much opportunity in the South African space for these smaller bolt-on acquisitions. It's a very well-managed company. So it's a company that I would be comfortable holding. And I think that once you get to a point where they are feeling a little bit more steady around what that business will ultimately look like, you do have an opportunity for them to increase their dividend payout ratio. But I think for them, the main story will probably be capital growth for now.
Thank you for that one, Chantal. I just want to move on to Kamogelo Mtembu's question here. That one is on NASPA's process. And the question is, why is the NASPA's share price high and for process low? And which one would yield the most gains if I want to bet on China's recovery?
So the NASPA share price is higher than the Prosus share price because it has less shares in issue. That is the only reason. Prosus NASPA holds a stake in Prosus, and Prosus holds all the kind of big individual companies that these two names are directly or indirectly invested in. But Prosus is the larger of the two companies if you look at it from a market cap perspective. Now, if you are going to see a recovery in the 10-cent share price, then it should reflect more in the Prosus share price, or all else being equal. And that's just because Prosus does carry a holding company discount, but NASPA carries a holding company discount on top of a holding company discount. So technically, you will have more of that impact coming through in Prosus. The thing is, though, that both these companies are working very hard to reduce those holding company discounts. And if you look at it that way, then NASPA is probably the more attractive option outside of just gains in the 10-cent share price.
I think a very important distinction there for us. We also have another question from Diboa Mugwedi. It's quite a question, Chantal. He says, please ask the panel about these shares' 10-year horizons. There's quite a few of them. I'll list them all, then we can go back to them individually. It's AB InBev, it's Mondi, it's Clicks, Mr. Price, and BHP. Let's start off maybe with AB InBev.
Yes, I mean, we're talking about a 10-year investment horizon. We're talking about beer. Now, we're not going to suddenly have a lot of additional people drinking beer over the next 10 years. What we will have is kind of seasonal spikes in beer and beverage demand that coincide with things like sports and summer. And you will see price increases coming through. So you can expect a pretty boring growth trajectory from AB InBev. they're also so large, it's very difficult for them to make acquisitions in order to supplement that growth from pricing gains. So I think it's going to be boring growth, but if they are able to reduce their debt meaningfully, you could start seeing a really nice cash flows that are coming through to shareholders. So higher dividends or share buybacks over time. So my thinking is that it could be one of those really great diversifiers that you have in your portfolio. You don't have to worry too much about it unless they have another marketing blunder in Budweiser. But I think that it's a nice diversifier, the more safe option, I think, over the next 10 years.
Let's talk about packaging and paper company Mondi. I think they're also out with the most exciting news of late.
Yes, so Mondi is in the early stages of talks to merge with DS Smith. Now, DS Smith is it's a UK-based company, and basically they make the boxes that e-commerce stuff gets delivered into, and they buy the box or the carton board from a company like Mondi. So what they're effectively looking at is a vertical integration move, which is always smart if you're looking to reduce costs and improve efficiency. And I think that those two businesses could complement one another quite well. The DS Smith share price reacted very positively to the news. I think it was up 13% on the day. But Mondi's share price came under pressure because Mondi is the larger entity, so they'll probably make the acquisition. And I think the market thinks that Mondi will have to perhaps issue additional equity in order to actually make that happen. They're also probably not sure about the quality of the DS Smith business relative to the very high quality business that you get when you are buying Mondi. Now, I think that combination could be potentially positive. And even if it doesn't happen, I think Mondi is a really great stock to have in your portfolio. It's super high quality. It does benefit from an uptick in global demand or global growth because of the consumer aspect and demand aspect that's related to its business. But it tends to be more defensive than, for example, your discretionary retailers. It's a slightly more defensive business, generating very high cash flows as well. So another stock that I would be comfortable with over that 10-year investment horizon.
And then Clicks. I think, Clicks directly competing with other retailers, but mainly Dis-Chem, a great festive period for the company, but also aggressive expansion there with a new store opening, Chantal. How does this one fare if we look, into that 10-year horizon?
It's going to sound like I like all the viewer stocks, but really, I do like Clicks as well. So I think when you're looking at the South African landscape and the pharmacy and beauty kind of retail market, you basically have the two big names that you mentioned, but there is still a lot of fragmentation in that space. So I do think that there's an opportunity for continued expansion there. And even within Clicks itself, it doesn't have a pharmacy in every single store. So you have that natural footprint that you can roll out pharmacy in, and then in that way kind of enhance that retail offering and provide more to Clicks customers. I also think their loyalty program is excellent. And then when we're talking about their distribution business, they just changed the way that they actually vet their client set. So they are after higher margin business, and they've cancelled some contracts that were lower margin. So I think that there's a possibility of higher margin business coming through in the UPD business, which should lift up Clicks' margin overall. The stock isn't cheap though, so you may have to hold it for 10 years in order to get your money's worth. But I think, again, a very high quality, well-managed company. I would perhaps look for a better entry point, but we know as well with Clicks, once it starts going, it's very difficult to call when it's going to start coming down again, because a fun fact from within the SA Inc. space, Clicks is the most foreign owned out of the SA Inc. names. So and foreign owners or foreign buyers tend to come into the market, they buy Clicks, and then they hold on to it for a really long time.
Very interesting there, looking at the liquidity of that stock. Let's also talk about Mr. Price. Do you like this one as well?
Yes, I like Mr. Price. So yeah, Mr. Price doing some really interesting things in a very tough market. The last update that we saw had them gaining market share quite significantly, which I think was really great, and that really spurred a bit of a pop in the share price. It still doesn't look expensive. I think when you're looking at value discounts and the place in which Mr. Price plays, they don't really have a true competitor in the South African sense. And one of the things that we were looking out for, particularly over the third quarter of last year, was whether or not there was a market impact from the likes of a Shein on Mr. Price, because I think that is probably the biggest threat to them. Everyone else is too expensive relative to quality, or it is at a much cheaper price point and catering to a different market. But I think that they've weathered the storm quite nicely. I think the complementary acquisitions that they made in Power Fashion and in Studio 88 and Yappy Chef really stood them in good stead over this last year or so as well. But I'm excited about the core Mr. Price apparel business. I think that they managed to turn things around quite nicely over the last few months, and momentum is now towards the upside.
And then moving on to BHP, that's in commodities.
Yeah, so I mean, BHP is probably the one that I like least out of that list. But when we are talking about commodity exposure, you would want a little bit of that in your portfolio, because you do have it is uncorrelated with the rest of the market to a certain extent, and you do have the benefit of when things turn around in terms of global growth, when things turn around in China, when the market realizes that not a single miner has actually invested in supply over the last 10 years, and that supply is going to start becoming an issue, you could see some really good support for commodity prices. Now, within BHP, your main exposures are basically copper and iron ore. Both of these, I think, will continue to do quite well over time, but remember, it is quite cyclical. Of iron ore and copper, we would probably prefer exposure to copper, just because it's one of those new metals to the future. So you do get that angle through BHP as well. But remember, it's a massive company. It is super diversified, and it is exposed to a lot of risk as well. Within the mining space, if I'm going to go for a diversified miner, it would probably be on my list. But yeah, it's a volatile story, right? It's the resources sector.
I think I hope Ndibo is satisfied with those ones, Chantal. I want to move on also just to look at some of the stories that came out this week, and I'm keen to get your thoughts on Lesaka. It was a very interesting one for me there, seeing narrowing losses. Now, they have a primary listing on the NASDAQ in the United States and their secondary listing here. And of course, this is a typical tech company, narrowing losses over a period of time. I'm wondering if the grace for that, which actually a tech company would have listed overseas, not really here at home, but as their investors watch their losses narrowing, the NASDAQ is actually the right place for a business like this.
Yeah, I do think the NASDAQ is a decent fit for them. I mean, I think one of the unfortunate impacts of having that listing on the NASDAQ, and we've seen that come through in some of the other South African companies or techie companies as well, like Curo, is you kind of lose liquidity in South Africa. So a lot of the liquidity in that company sits on the US exchange, and it doesn't sit here. And it's very, very difficult to buy and sell the stock. So we did a valuation exercise on Lesaka a few months ago, and we saw some value there, but it's just very, very difficult to buy and to actually buy at a decent price because of that. I think that they're doing such interesting things in their informal economy, and they announced earlier this week that they're going to buy Heineken's kind of transaction point of sale service that came out of the old Distel business, which I think is going to be so interesting, kind of focusing on taverns and kiosks in the township economy, which we know is a lot larger than people may think. So yeah, I mean, I really like it. I think that those losses will continue to narrow over time as they bring down their debt properly. The problem is just, how do I get hold of stock?
Definitely an interesting one. Let's also touch on Curo. They came out with impairment numbers this week, having to impair some schools that haven't performed quite well. This is something you don't hear of often in the education sector.
Yeah, I mean, it was a bit of an interesting twist. I think it's a natural progression to becoming a little bit more mature as a business. So they can kind of start saying, okay, well, we've got this J curve effect going. So we opened a school, we don't have a lot of students, the school is loss making. Eventually you get kind of your student numbers at scale, and then your operating margins just kind of expand. And then for some schools that just doesn't happen, and it's either location, or it is the wrong branding that they've gone out with, or perhaps it was an acquisition that was done at a pretty high price, and now they're at a stage where they actually have to look at what the carrying value is of some of these assets, and they have to think about impairments. So I think it's a natural progression of becoming a more mature business. It's not something that I am too concerned about. I think that there's still scope for growth in private schooling in South Africa. I think there's scope for it being a branded business, because there's an element of trust there. I mean, it's a huge deal sending your child to a school, and you need to make sure that you know that there is something underpinning that school. There's someone backing up that school. It's not just a few people deciding to open a school, because that can be quite dangerous. I mean, we saw again with the matric results, some of these smaller independent schools really, really struggling. So that for that reason, I still like Curo. I still like AdviTech. Probably in this market, I prefer AdviTech over Curo. But when we look at the share prices and the valuations, Curo looks a little bit cheaper than AdviTech. So yeah, it's a difficult one, but I think a natural progression for that business.
Well, it's all we have time for today. Chantal, always a pleasure talking to you. And thank you so much for being here for my first Stock Watch. And that was Chantal Marx from FNB Wealth and Investments.